Imagine you receive a significant sum of money, perhaps an inheritance or a sizable gift. While the extra funds may feel like a financial safety net, recent research suggests that most individuals opt to spend this unexpected wealth on immediate gratification rather than securing their future. What's even more surprising is that many of them spend it on items or experiences that align perfectly with their pre-existing desires before the windfall arrived. How does this happen? Why would everyone prioritize safeguarding their future by diversifying their investments, or at least setting aside some of this newfound wealth in an emergency fund? To understand this intriguing aspect of human behavior, we need to look at the role of framing in the world of finance. Have you ever noticed how certain foods seem to have a diet version and others a regular version? It's the same product, yet the packaging and marketing are different. In the financial world, this concept known as framing plays a crucial role in how we perceive and interact with money. Think about this. When we receive our monthly salary, it feels like a regular paycheck. We allocate portions of it to different expenses and savings without giving it much thought. However, when we get a tax refund, a lottery prize, or a bonus, we consider these sums as windfalls. Suddenly, the rules seem to change. Our perception shifts, and we start thinking about these funds differently. Sometimes we might impulsively spend them on non-essential purchases. Other times we might keep them in a checking account, leaving them accessible for unplanned expenses. Rarely do we choose to save these funds or use them to pay off debts. So why does the origin of the money matter so much? According to behavioral finance expert Richard Taylor, this is because our brains categorize money based on its perceived value. We subconsciously assign labels such as easy money, gift money, or hard-earned money. As a result, we treat these monetary sums differently based on the stories we tell ourselves about them. For instance, after receiving a large bonus, you might think, "I've worked really hard this year and deserve this extra money." So you decide to treat yourself to a lavish vacation. On the other hand, if you found a $100 bill on the ground, you might not spend it on a vacation. You would probably say, "This money wasn't earned, so I shouldn't spend it on myself." Even though the amounts are the same, your actions differ because your mind perceives the origins of these funds as fundamentally distinct. However, the reality is that there is no real difference between the two scenarios. From a financial standpoint, whether the money was found, gifted, or earned, it still represents the same purchasing power. This tendency to categorize money based on its perceived value leads to biased spending and saving decisions. These biases can significantly impact your financial well-being without you even realizing it. On the other hand, if you received a $1,000 bonus at work, you might quickly realize that it presents an opportunity to boost your savings. This demonstrates how the perceived legitimacy of money influences how we manage our finances. In both cases, the amount is the same, but our reaction varies greatly depending on how we mentally categorize it. Another example is the concept of pain money. This refers to funds that are difficult to acquire through effort, sacrifice, or discomfort. Fun money, conversely, is income that comes easily and brings pleasure. As a society, we tend to devalue pain money more than fun money, even though they hold the same economic value. For instance, if someone earns $1,000 by working overtime, they might view it as pain money. Due to the extra hours and effort required, they might also see $1,000 earned through investing as fun money, because it came from a passive income stream. As a result, we might spend or save the $1,000 differently based on how we categorize it. This effect is further amplified when we use credit cards, especially those with rewards programs. Because credit card debt is often categorized as fun money, we tend to spend it more freely compared to money we have saved or earned directly. Many people who carry credit card debt from month to month justify it by saying, "I've already paid for the trip or a new item with my credit card, so it doesn't matter." But the reality is that this mentality prevents them from fully appreciating the cost of their purchases. Moreover, when faced with the choice between keeping $1,000 in cash or on a credit card, most individuals will choose the latter. This preference arises from the fact that credit card debt is mentally categorized as a separate financial entity from the money in our bank accounts. Since it's not physically tangible, we become less attached to it and fail to recognize its true cost. On the other hand, if we have $1,000 in cash or a bank account, we naturally think twice before partying with it. The physical presence of the money makes it feel more valuable and psychologically harder to part with. Now here's a crucial question. Does this phenomenon of mental accounting have a significant impact on the choices made by the average person? A study conducted by researchers at Harvard University and Northwestern University sheds light on this issue. The study revealed that most people prefer to spend their money based on the perceived legitimacy of its source. For example, most participants chose to spend money won in a lottery or received as a gift on items or experiences that aligned with their aspirations before winning the lottery or receiving the gift. Ironically, these same individuals would not have considered purchasing those items or having those experiences if they had to use their own funds. This tendency to spend money differently based on its perceived legitimacy is not limited to everyday consumers. High-income earners also exhibit similar behaviors. In a study conducted with high-income individuals, 75% spent their bonuses. Although they knew that this money could be used to boost their savings or pay off existing debt. In fact, many of these individuals were already carrying high credit card balances. Despite this, when the extra money came in the form of a bonus, they saw it as a license to spend. But why does money coming from different sources evoke such diverse reactions? To answer this, experts like Soggy Katz from Ohio State University propose that we attribute different levels of legitimacy to various sources of income. Money we earn through hard work or sacrifice carries a higher legitimacy than windfalls or unearned income. Hence, we are more inclined to invest or save money we deem legitimate. However, unearned money, such as a tax refund or a lottery win, often goes towards impulsive purchases or non-essential expenses. So how can we escape this cycle of emotional spending and start using money wisely? One solution lies in creating a budget that considers all income sources equally, regardless of where the money comes from. Treat each dollar as a single unit with the same value. Avoid labeling money as bonus, gift, or debt. Instead, allocate it according to your financial goals and priorities. Whether it's investing, paying off debt, or building an emergency fund. By adopting this approach, you can break free from the limitations imposed by mental accounting and pave the way for more intentional and fulfilling financial choices. We've delved deep into a topic that challenges conventional financial wisdom, showing that the way we perceive and categorize money significantly impacts our spending and saving habits. As we wrap up this discussion, remember that your relationship with money is deeply personal and complex. There is no right or wrong way to manage your finances, but understanding the psychological aspects at play can empower you to make more informed choices. From recognizing the effects of framing to challenging the legitimacy of different income sources, each concept we've explored today offers a lens through which you can view your financial decisions more critically. As always, I encourage you to reflect on your own practices and beliefs about money. Ask yourself, how do you categorize different types of income? You find yourself treating money differently based on its source? Your answers to these questions can provide valuable insights into your financial mindset and guide you toward positive changes. And if you enjoyed this video, don't forget to hit the like button, subscribe for more insightful content. Share this video with someone who might benefit from these ideas, and join the conversation in the comments section. Together, we can navigate the complexities of personal finance, while considering the emotional and psychological factors that shape our financial journeys. Remember, your financial well-being is a holistic process that involves not just numbers and calculations, but also your beliefs, feelings, and perceptions. Embrace the power of knowledge and take charge of your financial future.